Welcome to the 2024 Volatility Review from 36 South. My name is George Adcock. I'm the Head of Trading and a member of the Investment Committee. We've made this presentation for educational and informative purposes. For those of you who aren't familiar with 36 South, 36 South is a long volatility investor. Our mission is to design and manage asymmetrical portfolios with an emphasis on crisis protection. If you could take a second to read through disclosure before we get on to the content. Before looking at 2024, it's worth understanding what the core trends were in 2023 as the year began. Bloomberg consensus growth estimates at the start of 2023 were just 0.4%. Throughout the year, they rallied as strategists were forced to climb a wall of worry as the economy didn't roll over as expected. By the end of 2023, consensus growth estimates were at 2.4% for real US GDP. The disinflationary trend that marked the core trend of 2023 was exploited by the Treasury Secretary Janet Yellen in the middle of the year, the quarterly refunding announcement. She used this disinflationary trend to attempt to term out US issuance by issuing more US debt in the longer end of the bond curve. The bond curve reacted relatively violently to this, selling off quite meaningfully from July through to November. Other financial assets also suffered during this period. In November of 2023, we saw the Fed and the Treasury via the QRA both pivot, the Fed moving to a long pause and Janet Yellen deciding to reduce the market expectation of what was going to come as long-end issuance. We finished 2023 with a very jubilant market. This led us into 2024 with 10 to 11% earnings expectations priced into US equities and the disinflationary trend intact. Other areas of cyclical data, which would have been picked up in things like the ISM survey, continue to perform relatively poorly. This confounded a lot of business cycle researchers who were looking for traditional cyclical areas of the economy to turn up to look for an improvement in the overall economy in aggregate. Part of this shift in expectations from both the Fed and the Treasury led the market to price a very steep rate cutting cycle into the US Fed funds curve. 150 basis points of cuts were priced into 2024. Something that we can see in currency market expectations as we came into 2024. These charts are prepared by Spectrum Markets and they look at both their customer base and strategists. And you can see that there was a general belief that there would be a convergence of rates between Japan and the rest of the world, as Japan was looking to a more hawkish stance and the rest of the world was seen as being dovish, and we would cut towards the yen. The other area that was interesting on here was that there was a general consensus that easing of monetary policy would be more positive for China-centric assets like the Aussie dollar. Looking at what happened to actual asset returns in 2024, there were two real standout performers from the soft complex. Cocoa and coffee registered multi-standard deviation moves from where their expected trend was. I'll remove these from the chart so that we can focus on the core financial assets. When looking at 2024, it was a good year for most financial assets. Stock markets were generally all green, and it was only really the long end of the bond market in the financial asset landscape that suffered. There were notable shifts that came in 2024. The HSCI registered its first positive year since 2019 and was the number one performer in our financial asset landscape. It was also the best year for gold since 2010 as we broke out a multi-year consolidation and we saw significant interest from Asian buyers in precious metals. Agricultural commodities continued their downtrend, exacerbated by a pretty steep contango that ate into returns for any total return asset holder. The other standout on the negative side was natural gas. At the start of 2024, Joe Biden issued a ban on new export permits for natural gas, creating a very, very steep contango at the front of the natural gas curve, which ate into returns, making it the most negative total return asset on the year. Interestingly, on a spot basis, nat gas prices were actually up on the year. This is going to become a particularly pertinent topic going into 2025, where Donald Trump aims to revoke Biden's export ban policy, and this will create upward pressure on natural gas prices on a relative basis. This becomes interesting as natural gas is 38% of the US primary energy mix, which will also start to create upwards inflationary pressure from the US energy side. If we're to look at the FX landscape and to understand how these trade charts work, these charts look to equal weight each FX pair against the other members of the G10 and indexes them over the year. You can see that we had very, very strong performance from the high yielders and deficit countries, both being the dollar and sterling. When we look at the total return, which is calculated by rolling the same contracts Tom next, we can see how wrong-footed the market got relative to its very disinflationary expectations and rate cut expectations in the yen. If you remember back to the Spectrum Markets pages, the yen was the number one predicted currency pair for the year, followed by the Aussie dollar, which also was a relatively poor performer. When we look at the EM landscape, two of the most popular trades from the 2022-2023 period, largest drawdowns, those being Mexico and Brazil. LATAM have been a particularly popular trend into 2022-2023 due to relatively high real rates and relatively decent proximity to America. Brazil was mainly weaker due to a number of Chinese-related weakness factors and concerns over loosening fiscal policy onshore. Mexico, on the other hand, was catalyzed by election uncertainty. I'm unable to calculate the total return for CNH, but what's interesting to see is despite quite significant consensus bearishness on the Chinese economy, on a spot basis, China performed relatively well. And given where the total return of where the interest rates are, really much eked out a kind of flat return for the year. The real standout performer on the total return side was Turkey, where rolling Tom next over the course of the year beat the forward by quite a significant margin. If we were to look at one macro chart to think about 2024, this would be my pick. When we think about the expectations coming into the year, we had a very, very large cutting regime, which can be shown by the differential on the bottom chart between where Fed funds to 2-year bonds were trading. Now, coming out of 2023, we had seen a relatively big surge in financial assets, and this translated into stronger data during Q1 of 2024 as established economic linkages created a wealth effect. By the middle of the year, most of the data sets had started to roll over. This culminated in the middle of the summer of a growth scare in August, where it was believed that the Federal Reserve was behind the curve. This led to calls for emergency cuts. You can see that the differential between the 2-year and the Fed funds really grew through the middle of the year, and it prompted the Fed to embark on a 50 basis point cut. However, when we look through the data series on the next page, you'll see that certain parts of the data surface had already started to turn up, and the market was very responsive to this cut. This actually leaves us coming into 2025 in a relatively tight stirs position, where when we look forward at forward interest rates, where Fed funds are, they're the tightest they've been for a number of years. The election in November only catalyzed this as growth expectations under the Trump presidency surged much higher. The following charts look at the different components of the US data surface, how the data came out relative to expectations. As alluded to in the last slide, you could see that coming into 2024, we'd had quite a big shift in financial assets from 2023 that had led to a kind of wealth effect in the personal and household sector as many of the other parts of the economy started to slide. However, as this started to slide, you could see that by the middle of the year, we really had like a consensus shift down in the data. When the labour market started to register negative surprises by the middle of the summer, this was what caused the real significant shift in believing that the Fed may be behind the curve. However, as alluded to in the last slide, you could see that certain parts of the data, for instance, the surveys and business cycle data, had already started to base and were ready to turn up. When we look at what that meant for visually for 2024 asset prices, as the disinflationary trend continued, we saw that core markets like the S&P had strong positive drift from trends like AI. The commodities landscape had benefited from what people thought would be a re-acceleration in kind of cyclical growth at the start of the year from trends like onshoring, AI and power that was kind of brought back down to ground by kind of realities around Chinese demand being relatively lackluster throughout the year, finishing relatively flat. As shown on previous slides, the stirs trend really drove the dollar and the 10-year, and you can see how correlated the kind of rough kind of zigzag is in them. And we finished, as I said, in a position where the stirs curve was particularly tight. So we finished with a very, very high dollar index, wides on the yields. The general wall of worry that we had seen through 2023 and had carried through into 2024, really by the end of 2024 had really ended. Growth expectations by the end of 2024 following the Trump presidency had surged to a point where now high expectations are relatively elevated for the market to meet in 2025. One factor that's worth thinking about as we come into 2025 is that we now have the first time we have negative equity risk premia to 10-year bonds since 2002. This will act as a significant valuation hurdle to the stock market going forward if rates would stay at this point. This drop in the equity risk premium has been driven by both sides of the leg, where we have relatively high earnings expectations against relatively elevated bond yields. Moving on to equity volatility, the following charts work by comparing 1 year applied volatility at the start of 2024 and comparing it to the daily realized move over the course of the year. We generally saw higher realized volatility relative to implied in Asia, where we saw relatively large policy shifts, first with the Bank of Japan getting off zero in terms of rates, and secondly in China, where there is a perception that policy may have reached a tipping point and is becoming more supportive. Relatively interestingly, one of the places where the data continues to be pretty weak is Europe, and we saw very sharp underperformance on a realized versus implied across the Eurozone. The US stands out in the middle, where really it was the Russell, which didn't create any actual spot return, but had very large realized shifts as expectations for growth and in value shifted up and down throughout the year. When looking at the actual shifts in implied vol, this just takes the 1 year at the money point and looks at the shift from 2023 to 2024. We've seen a relatively big shift towards Asia. Part of that is explained by the previous slide, where we've had much higher realized versus implied. So it's paid to own the vol. But the other is the change in expectation from the oncoming Trump administration. Another interesting point, again, on Europe, despite having relatively poor implied realized, I'm relatively surprised to see that implied vols are lower this year, given that we've seen European energy markets start to rise relatively rapidly, showing the continued weakness that is going to be prevalent in the European energy sector. If we compare the equity probability distribution from 1 year ago relative to what happened, we can create something called a realized Z-score. A realized Z-score effectively looks at what was priced in terms of distribution versus what happened in the spot prices. We can see that the places that it really paid to own options, and given they all the markets finished up, it was really calls that you wanted to own, was really the S&P, NASDAQ, and the DAX, both registering an over one standard deviation move to the top side. And again, following on from this kind of very poor implied realized dynamic where the markets have kind of churned and gone nowhere, both the Russell and SX5E failed to really perform. The Chinese market and the Nikkei did somewhat perform, but going in with a much higher vol base, the probability distribution they need to reach to get to one standard deviation is meaningfully higher. Another way to look at this is thinking that if you were a trend trader and you were buying a position at the start of the year, the S&P would have provided you the most bang for buck relative to the volatility at the start of the year. If you look at where this leaves us in terms of option pricing coming into 2025, you can see that this is a relatively cheap period to hedge your portfolio. The following charts are created using a linear Black-Scholes model, so there may be some deviation to real prices, but they give you a good illustration of where prices are relative to their history. Many of these are 80% puts in the 1 year space, are close to their all-time lows. This leaves us in a position where it's relatively cheap to hedge your portfolio relative to previous periods that we've seen. If we move on to looking at FX volatility through the same lens, you can see that risk premia in FX, the FX landscape really didn't perform. I've added on precious metals here just to give some context, silver being the only asset that it kind of performed on a realized versus implied basis. That's really from silver having very large up and down days over the 1 year period, which really kind of juices up the realized vol return. Interestingly, despite kind of like the relatively poor performance of risk premia, we walk into 2025 with higher kind of base implied vol expectations. This is really driven by kind of two factors. One is concerns over tariffs, creating kind of headline risk. And the second is that when you are generally in a dollar trend, there's a general positive dollar beta between implied vol and dollar returns. The only place we have seen implied vol marked lower is dollar India, where the central bank has been trying to stabilize the currency for the last year, and we've seen kind of a wave of corporate vol supply. The largest increases in volatility are really shifted towards those who are largely most sensitive to tariffs. That's really happening in the kind of China and Euro area, where in China we are threatened with relatively large tariffs on imported goods. And in Europe, I think it's import-based tariffs, but the larger one is probably payments into NATO and tariffs being used to kind of force those through. When you look at what you would have made money in by buying kind of 1 year at the money options at the start of the year, it was really the LATAM complex that made you money relative to where volatility was priced. You can see Brazil and Mex really leading the kind of performance of the underperformance, let's say, of FX pairs, up there with gold, which also had a nearly 2 standard deviation move. Interestingly, where a lot of the focus, again, we saw this in the FX return data, had been on a kind of relatively weak China. China last year really didn't go very far, and you were really overpaying for the vol just on a spot basis if you were looking for trend. Now, part of the trade, obviously, within China is about total return. So this would have been a bit more juiced up had you taken the kind of long dollar CNH leg. If we look into rates vol continues to relatively elevated versus the realized moves that we saw over the year. A lot of this comes from a very, very elevated vol surface in rates from 2022, and then following the QRA announcement volatility in 2023. Rates were relatively benign on a relative basis compared to that in 2024. But when we look, it's still the long end of the bond market that the concerns are really emanating from, where there is significant concerns about stickier than expected long-term inflation, and also how the US bond curve is expected to absorb a much higher level of supply given the deficit. Given this dynamic of relatively underperforming realized vol in rates, you can see that most of the volatility curves, most of the volatility points in this 1 year at the money space from swaptions are being pulled lower. Again, the same trend exists where there is significant concern about this US funding scenario, with only the US 30-year registering higher vol on the year. This is going to create an interesting dynamic because incoming Treasury Secretary Scott Bessent has promised to term out part of the US debt, which will only increase the amount of supply hitting that tenor of the curve. I know internally as a fund, we'll be watching his travel arrangements to see where he might be looking to broker deals to create demand for this US duration. Moving on to commodities, when we look at commodities on a realized versus implied basis, is a much larger dispersion of returns relative to the other assets class, which all seem relatively correlated. Cocoa stands out on a number of bases throughout this pack for being a relatively spectacular trade, whether you'd own the vol, whether you'd own the trend. You can see on this in the implied realized basis, we made nearly a 40 vol difference when you look at spot prices. Again, next to it, interestingly, Nat Gas, which on the total return was the worst performer. So you've got the best and worst performers next to each other, giving you over a 10 vol P&L on doing the implied realized spread. With that being said, quite a decent chunk of the kind of oils and products complex was a relatively underperformer through the year. With the end, you can see oil, heating oil, and gasoline there being quite significant underperformers on a realized basis. The dispersion in returns of the realized implied data that we saw on the chart before has followed through into the pricing for 2024. Unsurprisingly, cocoa vol being marked up to the highest. It's relatively surprising to see how much implied vols have been marked down in energy, given how sensitive this administration is or has said they will be about energy prices. Part of Scott Bessent's 333 policy agenda is to try and expand US production by 3 million barrels a day. Gold vol looks optically low when we look back against its kind of return profile. Given that it had its best year since 2010, if we look at where the same value for 1 year at the money vol was then, it was at 23.73 versus 14.62 today. So there's a real pocket of value there for people who believe that the trend will extend. When we look at what happened kind of as a trend in commodities, we can see that this really kind of is the same story of relatively large dispersion. On the left-hand chart, everything from oil to the right is a negative return, and everything on the left of that is a positive return. And I've put both the spot prices and the total returns on here, so you can see the kind of differences in natural gas, where we see that the spot return was actually kind of positive to 1 Z-score. When we include the negative roll of the contango, it was one of our more negative scorers. But really, the chief kind of things to own last year was this kind of softs complex, and precious did pretty well, especially gold. On the right-hand side, we continue to see kind of agricultural commodities trade relatively poorly. Agriculture might prove to be a pretty interesting place to be, given the phase 1 trade deal was very centered around Chinese agricultural kind of commitments on purchases. And with RFK Jr. coming in, there's going to be some headline volatility around certain kind of fertilizers and food qualities, which is going to probably create some relatively meaningful volatility. When we look through into 2025, the market backdrop's a lot more challenging than where we were at 2024. We've moved to a position where expectations are far higher, and the market now has to kind of grow into those expectations, which means that the kind of skew in probability distribution is kind of the downside surprise is now a lot easier than the upside surprise. And if we look kind of like at a starting point, in the STIRS market, as kind of alluded to earlier, we're now at the kind of the tightest policy position we've had in a couple of years, where term financing rates are really above Fed funds. And this is going to put kind of actually quite a significant tightening onto the US economy. When we think about kind of the effect that this had during 2024, as we had seen kind of rate cuts priced into the surface, that allowed those who were doing term financing to get a kind of preemptive stimulative effect before the Fed cut rates. And that effect really is kind of priced out of the market now. And when you look at kind of where growth expectations are and what the Fed's communication has been, there's a belief that we are close to an equilibrium rate. This removes this kind of stirs and forward dynamic in the interest rate market as being a supportive factor on the monetary side. If you compare this to kind of positioning and let's say kind of like slightly more growth assets, certain cohorts of the market have got themselves like particularly exposed to things like the stock market. So the below takes the kind of commitment of traders and looks at the asset manager cohort kind of futures length. And you can see that we are at kind of like a multi standard deviation high. Other areas of data, so like the Bank of America Fund Manager Survey, have the cash overweight as the smallest it's ever been, kind of reflecting this kind of relatively buoyant expectations that the market comes into 2025 with. Another data point that kind of shows kind of some of the extremity of this kind of sentiment shift is when we look at the conference board net number of people expecting where they kind of expect stock prices to be at 30%. We're at kind of a relative high for the kind of last kind of 30 or 40 years. And the red lines mark when we've had those high. And what we generally see is that the market has to kind of grow into those expectations, or we generally see kind of downside surprises. In the year 2000, we saw a relatively downside surprise. 2004, the market had to kind of grow into those expectations for about a year. 2018 started off kind of the start of kind of a slightly more kind of like volatile period in assets. And, we'll be unclear at this point to show what 2025 says. But, when you triangulate all of these things together, expectations remain very, very high for financial asset returns. So if we think about consumers having very high expectations, this is also actually being followed by the street, where we can see this chart from Renaissance Macro Research shows the shift higher in 12-month S&P forecast. And generally, you can now see that the strategists from climbing this kind of wall of worry are now chasing the market higher and have had the biggest rise in change in S&P forecast that they've had in the time series. And if you again look, the kind of general theme here is that the market really needs to grow into these expectations, or the downside surprise becomes like quite meaningful. When we take a look at kind of the backdrop of what's kind of driven this recent kind of like, let's say, S&P bull move from 2022 to 2024, there were really kind of like three composite sectors that were leading the recovery. And as I kind of said earlier, that many of the conventional cyclical kind of upside parts of that you would have been looking for, and many of the cyclical upside factors you'd have been looking for turn up in the ISM, turn up in certain energy prices, things like that, really haven't turned up. And it's really been led by kind of three component parts, and they're semiconductors, housing, and industrials. Now, these charts look at those as an index relative to beta. So there is a kind of market weight one on top and an equal weight one below. And what you can see is that the kind of cyclicality, the momentum has really come out of that cyclical upswing. Relative to like kind of the very high growth expectations, that's a very kind of challenging outlook. Whether you compare that to when Trump took office in 2016, we were really already in an upswing. So there's a big question to be asked of where the next part of the cyclical upswing can come from. If we took kind of housing as an example, housing inventory has been growing quite significantly, and we now have a mortgage rates within the sevens. It's quite hard to see that part of the economy being quite as supportive as it has been for the last couple of years. Again, the semiconductors bucket is relatively kind of affected by the AI trade, but what we started to see is that quite significant parts of that sector leadership have been rolling over. The final part of kind of why I believe that 2025 is probably going to be a slightly more challenging year is when we look at kind of the liquidity landscape and some of the programs that have been implemented over the last couple of years. The kind of impulse from those is really kind of slowing down. If we were to look at the kind of program being run by Janet Yellen, where she's kind of not terming out the debt. She's issuing a phenomenal amount of the kind of interest rate expense right at the front of the curve. And that has a stimulatory effect for those who need to buy kind of back end bonds. And that is noted under the kind of not YCC column here from Cross Border Capital. And then if you were to look at the Fed, we've had various programs that have involved the balance sheet, the Bank Term Funding Program, the RRP, where the effect of those is starting to kind of wane on an impulse basis. And we're now in a situation where we've had a relatively tight dollar, we've had relatively high interest rates, and we've had recent oil kind of shifts at the start of 2025, where liquidity in the system is tightening and is going to, all things being considered through economic linkages, should start kind of creating a slowing impact on the economy against these like very, very high growth expectations. So going into 2025 is going to be kind of I think, quite a challenging year. I think it should be a pretty interesting year for volatility. The Trump administration is going to create, I would think, significantly more headline risk than we've had. But the underlying cyclical dynamic of the economy seems to be slowing to some degree. And that is going to kind of clash with where we kind of what the Trump administration is able to do. And I think, where we could end up is a position where the economy is showing quite different things to expectation, and we get relatively large repricing again in assets. I hope you've enjoyed the presentation. We are going to aim to create quite a bit more content on specific things going forward within the volatility landscape and where we think there might be some opportunities. If you've got any questions, if you'd like to get in contact with me or the firm, please contact us at ir@36south.com. And I hope you have a great day.